Take it away, Ted.
Thank you. Good morning, good afternoon, good evening, wherever you may be in the world today. My name is Ted Davis. I am a Chief Financial Officer with Escalon Services, and it's my pleasure to host this particular webinar today regarding Meet the VC. Today we have two sponsors that are sharing their information with us today. One is JustWorks, and the other is PAG Law. Let me talk a little bit about JustWorks first. JustWorks is a professional employer organization, PEO, that offers cloud-based HR software platform and services to help small and medium-sized businesses manage their HR relationship responsibilities. JustWorks HR software allows businesses to access and maintain employee information, such as payroll, staffing, benefits, and healthcare enrollment from any device. JustWorks PEO services bundle payroll, compliance, HR, and benefits into one offering. This can help businesses streamline operations and navigate the complexities of managing a workplace. Some say that JustWorks is just easy to use and a great customer support, but I'm very, very happy to welcome them today as one of our sponsors. I'm also very, very happy to introduce Esteban Elias from PAG Law. PAG Law is a legal firm, and I'll leave the information delivery to Esteban. Nice to have you with us today, Esteban. Thank you for coming.
Thank you, Ted. Happy to be here. As you mentioned briefly, I'm a partner at a we call it a boutique law firm with offices in New York and Miami. We're heavily focused in attending and serving Latin American clients doing business in the U.S., mainly in the corporate side. Our main line of work is based on venture capital and corporate work in general, M&A, restructuring, financing rounds. So the way we work is that we try to work closely with with companies. We also work with funds. We know them very well. Many of the members of the firm are also entrepreneurs. So we have that kind of entrepreneurship approach when serving clients. So happy to be here and participating to this very, very interesting webinar, and also happy to be engaged in any conversation. Thank you very much for the invitation.
Thank you for coming today. As I mentioned, my name is Ted Davis. I'm the moderator today, and I'm a fractional chief financial officer with Escalon Services, specifically dedicated to strategic planning, modeling, capital formation activities, complex accounting interpretations, and so forth with regard to providing those back office services to our clients. It's with great pleasure that I also take an opportunity today to welcome our guest, David Rogg. David, it's a pleasure to have you with us.
Yeah, it's great to be here. Appreciate you guys having me.
Let me tell you a little bit about David. David is a founder and managing partner at Reformation Partners, an early growth equity firm based in Miami, Florida, focused on fast-growing, capital-efficient vertical and application SaaS companies between 500,000 and 3 million of ARR. For those of you who might want to know what that acronym is, it's average recurring revenue. Okay. David was formerly vice president at First Mark Capital, a B2B and B2C venture capital firm based in New York City. Prior to First Mark Capital, David worked in the capital markets and investment banking division at Goldman Sachs. David graduated as the valedictorian and summa cum laude from Dartmouth College. It's a pleasure to have you with us today. And I just want to mention before we begin our conversation today, David, that to all of our participants, during the course of our presentation today, we'll be basically doing some chat box activity with some polling and some questions. Please feel free, participants, to go ahead and participate in that. We'd like to know as much about you as we can, and obviously welcome your questions at this point in time. And we'll actually be having a little bit of a Q&A session towards the latter part of the presentation. Let's dive right in. David, let me ask you just a very important question, I think, for our participants today. Tell us about your career path and what got you into the early stage tech investing market.
Yeah, absolutely. And again, appreciate you guys having me on. So I've always loved tech, always loved software, and have a background starting in the finance space. So for me, early stage tech investing was a fusion of two of the things that I like most. Grew up in Rhode Island, went up to New Hampshire for college, then started my career in more traditional finance at Goldman in the capital market side. Always knew, as I'd mentioned, that I wanted to get into tech and software. So that brought me into the traditional venture world. So as Ted mentioned, started at Firstmark, classic Series A seed investor based in New York, portfolio across the US, both enterprise and consumer focused. Thought that was fascinating, kind of joined as an associate, mostly focused on diligence and board work, and then obviously evolved through the years there. Um, Ended up leaving to found Reformation in 2019, motivated by thesis that can get into in a second, but something that felt like it was missing from the traditional venture world. And we built Reformation to, I think, in a lot of ways, like startup founders see a hole and build something to fill that. That was very much our mandate in the early days at Reformation.
Well, thank you. I appreciate that background and introduction. Uh, Moving on with regard to Reformation Partners, tell us about this thesis that you mentioned and what your outlook is with regard to investment criteria and overview.
Yeah, absolutely. So for myself, I have two partners who were colleagues for several of my years at Firstmark. The three of us were seeing, particularly in the latter years, so think I joined there in 2014, so 2017, 18, 19, the emergence of these phenomenal SaaS companies, both vertical and application. Companies that just didn't need that much money, didn't need to get on the traditional venture path, didn't need to raise that many times, didn't need to raise as much, didn't need to take as much dilution, just fundamentally more capital efficient businesses than sort of the more traditional venture path, which, as many people might know, tends to be more power law, right? So companies like Uber, companies like Airbnb, companies like OpenAI, massively capital intensive. If they work, they're worth billions and billions. Obviously, a very high probability they don't work. For a lot of SaaS businesses, that's just not the capitalization path and not the risk path. These are companies that can get customers, solve a pain point, build revenue, build profits, which can sometimes be a bad word in venture, but shouldn't be, and compound growth nicely, get to 10 to 20 million plus of ARR profitable, and then have a ton of natural acquirers, both strategics and financial buyers like private equity. And we were seeing more and more of these companies emerge. We loved these companies. The joke was always, we wanted to angel invest in these companies, which was always an issue. But you couldn't underwrite them from the venture side because they just weren't these binary sort of lottery ticket type bets, which is what venture is perfect for, what venture is built for. And we'd have these conversations with these founders. Either we'd see them raise venture, and all of a sudden you'd have some perverse incentives enter, where you'd have a company that's in a really interesting deep vertical, and all of a sudden they raise capital that expects them to have 5 verticals very quickly because they need to justify being able to be a billion-dollar business. Or a lot of companies that just couldn't raise venture because they fundamentally weren't, venture scale businesses. And we kept scratching our heads and wondering, why is there no better partner for these businesses at the early stage? We looked at the ecosystem. Growth equity is a phenomenal fit for this more bootstrap style software business, but typically not till the company is at 5 million, 10 million of annual revenue. And that for us was the light bulb moment. We love the Series A stage, that strategic stage. You have numbers, you have data, the company's growing, the company's working, you found some form of repeatability, but it's still early, right? You're still very much in the strategic phase that we love, and that was our experience at Firstmark. But again, on that more growth equity style path. And that Venn diagram we didn't see exist. And that's exactly what we built Reformation to be. We're investors, we're not branders, so we call it early growth equity. Probably could be a more creative title for it, but that's exactly what it is. Taking that more traditional growth equity playbook, applying it earlier in the company's journey to that core sort of Series A stage. Specifically what that means, and Ted, you alluded to some of this, we tend to work with companies on average, I'd say 1 to 2 million of ARR, annualized recurring revenue, but as a broader range, sort of 500,000 to 3 million of annualized recurring revenue. We like momentum. We like repeatability for the companies we work with. Typically, that means they're at least doubling, in many cases, well north of that. And then capital efficiency is super important. So these doesn't necessarily mean the company's profitable, although it certainly can be. But usually you're burning because you're growing, and burn is modest, and the capital in to date is modest. And it's founders who have their hands on the dials, could turn things down if they needed to, and really raising opportunistically because things are working, not because they're sort of slamming into a wall, which is more the traditional venture path with scaling, right? You keep raising, and you spend, you burn, you spend, you burn, you spend, you burn. This tends to be a little bit more of a pragmatic path. And then just in terms of the path, I know we'll get into, but just to further outline what we do, we invest when companies are at that stage. Our check sizes are typically in the $2 to $5 million range. We lead rounds, only do 4 to 5 new investments per year. So pick our spots, spend a ton of time with our companies, help them grow, help them compound growth. Typically, once they get to 3 to 5 million of annualized revenue, if they choose to raise more money, we'll help introduce them and help them raise a growth equity round from some of the traditional players I was talking about prior. And then that's really the last round many of our companies ever need to or want to raise. And I think that's the big difference from the venture path. Rather than, I think on average, it's 8 to 12 rounds for a successful venture-backed company. Our companies maybe raise 2 or 3, and because of that, can win big with realistic exits, right? You can exit for $100 to $500 million and have a tremendous outcome as founders and investors because it's underwritten the right way, versus sort of needing to have the $1 billion pie for the small slices by that point to make sense. So
because you've done so many rounds, huh?
Exactly. Yeah. I mean, on average, every round is 20 to, probably on average above 20% dilution, probably 25% dilution or so. So if you do, 8, 10, 12 of those, you do the math, you're slicing the slices of the pie pretty thin.
I understand. You also talk about your team effort in this situation. Can you tell us a little bit about your team and their background?
Yeah, absolutely. So there's 3 partners and co-founders of Reformation. We all work together at First Mark, so we've now been investing together for over a decade. All come from investing backgrounds as opposed to operating backgrounds. One partner started his career at Insight, which is one of the traditional growth firms that I was talking about prior to joining First Mark, and all sort of saw this pain point in our days looking at companies and talking with companies, and all sort of came to this thesis in tandem, prompting us to start the firm. In addition to the 3 of us, we have 2 other team members on our investment team, Jess and Gabe, who help us identify new companies and vet companies and help us find the next great portfolio companies.
Thank you very much for that. I did have an opportunity to review your team on your webpage, and you certainly have very impressive co-founders and your investment team as well. So I wanted to just make a comment on that. We are in a situation right now where, just reflecting back on what you touched on initially, how would you say that this particular viewpoint, this particular path that you take to investment capital, differentiates your firm, and how is it different from the traditional path?
Yeah, absolutely. And I think I alluded to it a little bit, but the traditional venture model was built for capital intensive, very high potential outcome with low probability type companies. So I gave a couple of the classic venture plays, right? You have the Metas and the Googles and the OpenAI and a bunch of consumer marketplaces, some of which I mentioned. Those are absolutely perfect venture bets, right? They take a ton of cash, and at scale, they can be absolutely massive businesses. Software companies, in some cases, can be like that. In many cases, especially when they're in specific verticals, don't have that characteristic. They actually, if you look at the data, much more probabilistically, if they're successful, will sell to a strategic buyer. So think a platform, a Salesforce, the HubSpot, looking at the sales stack, a Salesforce, a HubSpot, those types of folks. In verticals, whether they sell to an EHR in the healthcare space or they sell to a broader platform in industrial automation, those tend to be big acquirers, as well as private equity. Private equity absolutely loves software because they can be really profitable businesses. And those buyers tend to buy companies in the $100 to $500 million range, which again is a really, really, really strong outcome if you capitalize right and you have the right investment partners. but is not a good outcome in venture. Venture, you take a lot of swings, a lot of those swings you strike out, and then you hope you get one or two swings that are, the next Airbnb. And that's a venture fund, and that's a very successful strategy. The problem is for all the strikeouts, for the companies that didn't need to be strikeouts, it didn't need to capitalize as strikeouts, but could have had a much higher probability path of getting to 15 of ARR and profitable and selling for $150 million. That's exactly the type of path that we are more interested in and growth equity is more interested in. So I think that's the key difference. And again, certain types of companies this is a fit for, and certain times it's not. If you need a ton of cash, you kind of have to follow the venture path. But if you can be more capital efficient, I think, and more opportunistic with your fundraising, I think this is this makes more sense. And then in terms of this versus traditional growth equity, so if you think about the growth equity landscape, I mentioned Insight, there's Spectrum and Vista and TA. There's the sort of the classic garden. Now there's lots of next gen players in that space. Phenomenal fit for these types of businesses. But again, they tend to be later stage, right? So historically, what's happened are these companies have had to just bootstrap until they get to 5 million of revenue, which can take a really long time if you can only fund yourself through profits. And that's why we built Reformation, because our thought was you can be more opportunistic, you can get there faster, and take on, again, in our mind, it's sort of 2 to 5 million. That's what we've seen be effective for our companies to help get to that next traditional growth equity stage faster. Or some of our companies don't want to raise again, and that's all good too. And the idea is just compound growth profitably.
I understand. Basically, that process that you just described of bootstrapping into a successful situation, how long is your path? Now, how long do you envision that would take for your companies to basically scale and grow and scale and grow?
Yeah, it depends on the company. For our successful businesses, and again, we on average invest, let's say, around $1 million of ARR or annual recurring revenue. For those businesses, and I'd say our average growth is probably approaching tripling at the point at which we invest. The company, if things go according to plan, will continue to north of double the first year. And then growth, obviously, law of large numbers, growth gets harder and harder on a percent basis, but you need to keep adding incrementally larger amounts of ARR, net new ARR each year. So usually our successful companies will get to growth equity phase somewhere between 1 and 3 years after we invest, depending on how fast they're growing at that point. And the idea is, again, have it be purely opportunistic. We tell all of our companies and all of our founders we talk to that aren't our companies, try to avoid ever being a captive to the capital markets, especially downstream, right? Raise only because you want to and because there's a reason to, and there's an opportunity to parallelize versus doing things in serial, as opposed to, hey, I have 18 months of runway, then I have 10 months of runway, and then I have 2 months of runway, and I better raise now or else I'm not going to be able to make payroll. I never think that's a good way to build a business if you can help it.
I understand. Yeah. You also talked about interaction with your founders, and when you and I talked initially, you specifically said you're looking for, if you can, second round founders or third round founders. Why do you take that viewpoint?
Yeah, it's a great question. So if you look at our typical founder persona, I would say it's very different than the type of founders we worked with from like FirstMark or on the traditional VC side. A lot of the founders we work with have started a prior business, and in some cases, it was a software business, but actually in many cases, it was more of a tech-enabled services or services business in the space that they come from, and that produced the pain point that they're then building the software to solve. So I can give some specific examples later. But we love those founder personas where you've lived the problem, right? You are your own customer. You recognize the issue. You've pulled your hair out. You kind of tried to solve it manually. You probably started building software as part of your business to fix it for yourself. And then you eventually had that light bulb moment of this is actually more valuable than what I was doing. And that became the business. And you had customer relationships to start selling it into. And that's sort of, probably a year to 3 years before we get involved. And we see that quite a bit. I think those founders tend to be more pragmatic. Again, they tend to not want to be this, I'm either going to be $1 billion or I'm going to be a zero. They like the idea of, getting what I always call it the pie argument, right? They want to own a nice size piece of a moderately probable, solid size, good size pie, $100 to $500 million pie, rather than a really, really small slice of a low probability, really big pie. And that's the types of founders I think that background tends to comport there. The other type of founder we do sometimes see and we've invested in are folks who have come out of a venture-backed business and just didn't like that path for all the reasons that I've sort of alluded to, didn't like the constant raising and burning and sort of the growth at all cost mentality. So we do get some founders with that profile as well.
Very good. Just talking about some of the elements that need to be in place for companies that are looking to expand and have capital formation activities. How important do you think their professional backing is into the overall process of your investment criteria when you take a look at a company? Are you concerned about who their accountants are, about who their lawyers are, about how management interacts with those, and how far they've gone with regard to the preparation of, say, the due diligence package or the deck or something of that nature? Can you make a comment on that?
Yeah, I'd say absolutely. I mean, with the caveat that we traffic in early stage businesses, so nothing's ever going to be perfect, and there's always going to be stuff to clean up, and we know that, and that's something we help our companies do, following the rounds we invest. But yes, I mean, for a couple of reasons. One, on the finance side, and I think we'll get into some do's and don'ts of diligence later. Having your stuff together and clean makes your process so much easier. We've seen plenty of founders ripping their hair out because they're in the middle of diligence and realize their numbers just have issues. And that's the last thing you need to happen at that point. So I think that's very helpful, especially when you go into legal diligence, sort of next level diligence. The cleaner they are, the better. And legal is super important too. And that matters less, I think, in the diligence phase, more once you start, post-term sheet and legal diligence and moving forward with the deal. It's always incredibly helpful if you're working with counsel that does these types of rounds all day. Like we and most firms use a very standardized set of docs that, frankly, I'd say 97% of them don't need to be negotiated because they're the market standard NVCA, venture financing docs. And if lawyers do these types of deals, they'll get that and that's it. If you have a lawyer who doesn't do these types of deals and starts litigating points that just, litigate, you end up just wasting a ton of money. And we've had companies that need to basically, switch counsel mid-deal just because they're spinning their wheels so much, and end up with a counsel that, does a lot of venture deals or growth equity deals. So certainly important that you pick the right partners. And again, I'd skew towards partners that have done this before, right? It's not rocket science. It's sort of, these are not crazy transactions, especially at the early stage. So you just want someone who can sort of rinse and repeat the process.
That wisdom and experience is gained from the first time going through it is definitely invaluable during the second or third time around. That's for sure. I wanted to basically just also take your comments with regard to professional services and ask for a comment or two from Esteban. He was shaking his head as you were talking in this situation. And so I think he has some comments that he can share, at least with regard to legal services and how they play an important part in this process.
Thank you, Ted. Yeah, no, I think what David was saying, it's so important for some companies because I cannot tell you how many times we see that some deals fall apart just because they don't have the right corporate legal structure. So a company might have a great product, a great service, and a lot of times we as a law firm come into the transaction, exactly as David was saying, kind of late in the game to realize that everything that the company did in the past was not properly structured. And the good news for some of the people who are attending this audience is that right now in the venture world, everything is so standardized. Everything is done according to NVCA documents, but you have to be knowledgeable. You have to work with law firms that understand how those documents work, how the structures are being done. And if you work with the right partner, it's a very simple, straightforward process. However, if you're working with the wrong law firm that is probably not used to working with those documents, you're going to find yourself in a number of issues, problems. And at the end of the day, it's going to end up being very expensive for the company. And more importantly, sometimes, again, as I said, we've seen situations that the company cannot even close the round just because the whole company structure from a legal point of view is not properly designed. There are some, pitfalls and a number of issues that we see. One of the main things that we discuss with early stage companies is that make sure that you engage the proper type of legal service that you need. I know that right now it's very tempting to access certain platforms, some online services that seem to be very appealing because of the cost component. But at the end of the day, you're not getting what you need, and something that seems to be very good from the kind of cost-effective point of view ends up costing a lot of money for the company. And as I said, more importantly, can really jeopardize the opportunity for the company for keep growing. So
yeah,
those are
thank you.
those are my 2 cents there, and happy to work with you guys.
I can certainly say that the professional services component of this entire process of capital formation and actually growing your company turns out to be a journey, more so than founders believe initially. Wouldn't you agree, David?
Yeah, absolutely. And I mean, it's totally understandable when you're starting a business and you have 5,000 things going on to say, oh, I need to have proper documentation of board consents and stockholder consents and make sure I've, incorporated the right way and have certificate of good standings and all these things. And I totally get it. The reality is if you decide to raise money, you're going to have to do all this stuff. And if you haven't done it in real time, it's just going to be a headache at that point. So, easier said than done, but to the extent, and I think the companies we've seen do it best are those that, again, work with law firms that have done it before. And therefore, it's sort of like, again, the worst thing you can do is waste a bunch of money working with a firm that everything is rocket science because it's going to be, both time and capital consuming. But ideally, you want someone you just shoot a note to and say, hey, we held our board meeting. We need to spin up this board consent. And they send it to you, 2 hours later, right? And then you're properly documented for the quarter. Stuff like that just makes your life way easier because when you raise a round, think of rounds are checkpoints, right? When you get to a round, that's a checkpoint. Has everything you've done up to that point been done appropriately? And it's the time that everything gets cleaned up. So the more ahead of it you are, the less you're going to spin your wheels at that point.
Very good. Thank you so much for those comments, gentlemen. I really appreciate it. I wanted to circle back just for a second regarding this efficiency of capital discussion that you initiated when you were talking about some of the elements of your of Reformation at this point, David. How important in your mind is efficient use of capital?
Super important. It's super important. I think the question is, what are the right uses of proceeds before we get involved and after we get involved? And I'm the first person to tell a founder when I speak to them, like, not all founders should be raising money at any given point, and there's the right time to raise money and there's the wrong time to raise money. And in a lot of cases, we'll talk to founders and it both conclude at the end of the call, like, you shouldn't raise yet. You're not ready to raise yet. To me, the right time to raise capital and when it will be most capital efficient is when, as a founder, you are at a point of repeatability. What that means is usually it's on the sales side. Products you figured out. You figured out the features that sell. You figured out the features that don't sell. You figured out all your gaps. You figured out how to sell against competitors. You've done your battle cards. You've won a couple of those sales. And all of a sudden, your pipeline just starts filling up. And you, as a founder, you're probably doing a lot of sales and you're going crazy. And you maybe have one AE and your burn is really coming down because your revenue is starting to really grow and you're doubling or tripling or quadrupling, low numbers, obviously, but things are really starting to work. That is when we most typically get involved. And that's because, again, you've kind of, at that point, you could probably get to profitability. You could probably fund yourself to profitability, but you're going to hire one sales exec, one AE a year, one account executive a year, right? But all of a sudden, now if you raise $3 million, you can go hire 3 AEs and 2 people on your dev team, right? And all of a sudden, you could build your product roadmap much faster, and you could just go out and close these customers that are starting to pile up or prospects that are starting to pile up much faster. And that's typically when we see the capital be most effective and most efficient. If you raise it too soon, capital raised tends to be capital spent, as a general rule in this world. So if you raise it too soon, you're probably going to waste the dilution figuring out how to get to repeatability, which just tends to be a less efficient use of capital. And obviously these startups are all about you crest a hill and then you find out there's a bigger hill behind it and a bigger hill behind it. So I say this oversimplistically, you'll hit repeatability for 3 months, then you'll find out you have a huge product gap so these things are all iterative. But that and $1 million of ARR is sort of the line in the sand heuristic, and I think has basis in reality. That tends to be when things are starting to scale. Sub that, you could kind of have gotten lucky with a couple good logos, and obviously, well north of that's a different story. But that's usually that triangulation point of, let's say, 600, 700K ARR up to 2.5 of ARR. That's usually where that feeling begins to arise.
Yeah, it becomes more evident, doesn't it?
Yeah.
We've talked specific. Go ahead. I didn't mean to interrupt. Go ahead.
No, I was going to say, and just to finish on the question in terms of capital efficiency, the reason a company raises is to spend money, right? Because you know the use of proceeds. So when I talk about capital efficient, that's not to say, like we invest our money so the company always stays profitable. Obviously, why would the company raise in that case? So generally, with all rounds, you have a J curve, right? So maybe you're at profitable or you're burning 50K, 100K, whatever the number is, depending on your revenue. And then you're going to start spending, and it takes a while to ramp salespeople, it takes a while to ramp developers. The developers have to build the features that you then have to sell. So inevitably, you're going to continue to burn, but the idea is that you build out your team a bit, and then those people start to pay off. And as those people start to pay off, you asymptote back to profitability, and then you get back to profitability. And that's sort of the J curve that you want to see and expect to see. And what matters most is that the amount you're raising has more than enough to fund you through that J, as you plan it out. And Ted, I'm sure you guys do this all the time on the CFO side. That's the model, right? It's, hey, do we have sufficient margin of error, assuming everything doesn't always go to plan, such that we never have to, fear running out of money again, but we have enough to fund that period of burn, so that we can build the team, spend the money, drive the revenue, and get back to, in control of our own destiny.
Yeah, it basically gets you into that position where you can actually achieve critical mass. Critical mass meaning that you've got enough sales, enough cash flow, enough going on in terms of the momentum that you discussed, and that growth year over year to be able to not necessarily need another round or additional funds or something of that nature, that you've achieved that strategic milestone. And going forward, you literally can use that efficiency to selectively, control your destiny at that point in time, and your scalability. Those are the things that I talk to clients about all the time in terms of when do you get to critical mass. That's one of my favorite questions, actually, and I think every startup should be asking that question as they go down the road and they do capital formation activities and so forth. There's a lot of details involved in the overall process. But the question that I just want to plant in their mind is that it's not an endless supply of money. It basically has to be focused and used effectively as well as efficiently, and get to that critical mass so that you can literally sustain yourself and move forward and get out of the loss position that you find yourself in a startup. So just a couple of comments in that regard. Tell us a little bit about specifically about this go-to-market and product interaction that you're looking at, David. You talked literally about the J curve, but that involves really the whole idea of having a very well-established strategic plan with regard to the use of proceeds from the standpoint of go-to-market, and what kind of results you anticipate from, saying, expanding your marketing effort and scaling and things of that nature. Can you give us some comments on that?
Yeah, I think, and we spend a lot of time on calls with founders talking about where you're going to, source of proceeds. We understand what's the use of proceeds, right? And how believable is it, and how much have you sort of figured out, where this is going to be spent. And again, I think sort of these are heuristics, but a heuristic for a founder is if you don't have a great answer to that question, you probably should not yet be raising an institutional round. Because I think, again, if you do that too soon, you're just going to probably end up wasting some of the dilution that you're taking for the business, or you're taking a mortgage too early for the purchase of the house. And so I think it's really nailing, like, what are the key product gaps and what exactly do I need to fill those? Like, what do I need to invest in? You said marketing and sales. Those are different things. Do I need a demand gen marketer? Do I need a brand marketer? Do I need an AE? What does the AE look like? Do I need someone with 2 years of SaaS sales experience? Or do I need someone with 7 years of domain expertise, or 15 years of domain expertise who has sold into agricultural producers if I'm an ag tech company? It's really specific, and it's really particular per company. And only the founder is going to know. And the only way they're going to know is by having enough data points that hit them over the head that suggest what the right path is.
Very good. I wanted to move on at this point in time and actually ask about a couple of specific questions. They're more narrow in scope, but I wanted to touch on them anyway. David, could you come make a comment at this point in time regarding the policy at Reformation Partners on investing in competing companies? Do you ever get into that situation where you're funding competitors?
Yeah, we have not. And generally, I think most investors want to avoid it. The idea is obviously you creating a long-term partnership with a company. So you want to, you don't want certain competing companies. I think where it can get more nuanced for some investors is those with, and Reformation, we've been around 5 years. You have investors who have been around 20 years or 30 years or 50 years. And at that point, you have lots of different funds and lots of companies, different funds, and so you might have more blend. But certainly in the early years, you try not to touch competing companies.
I understand. Very good point. I had an opportunity to go over a few of the companies that you've worked with on your website, but can you give us a comment and a walkthrough on a couple of your recent investments and give us a flavor as to the types of companies that you like?
Yeah, absolutely. So I can talk about a couple of the most recent deals that we've done, and I think are emblematic of some of what we've been talking about. An investment we made last year is company called Air Expert, based up in Buffalo. Founder is exactly the profile that I was talking about. So this company builds software for airlines and other use cases downstream around aircraft maintenance. So particularly on the collaboration side, if a plane goes out of service unexpectedly, currently the state of art is everyone hops on their phones for text, email, and phone calls to get the plane back in service. And every minute the plane's out of service could be, tens of thousands of dollars of lost revenue for the airline. So it's basically chaos. And that's at the moment. And then the plane gets fixed and it all lives in text, emails, and phone calls. So none of this stuff gets libraried. So Air Expert, the founder of that company, has spent his entire career in aviation maintenance. So back to that sort of core founder persona, he built an MRO, which is a third-party maintenance org at the Buffalo Niagara Airport, recognized his pain point, built the software, and that's eventually what we invested into. And again, because of that background, really understands the pain point, really knows the customer, knows a lot of customers, can get in the door with, you name the airline, he probably knows someone there, has worked with someone there. And because of that, just has a great sense for product and needs, and also is able to talk to the customer. And I think especially as you talk about vertical software, meaning software built for a very specific industry and type of customer and user persona, it really helps having someone who's been in that industry because they have immediate credibility, which I think helps close sales. So that's one business we did last year. Two investments we've made this year so far, also both vertical software businesses. One company called Embark, based between Utah, TED, as well as California. And they're focused on the behavioral health space, particularly for behavioral health treatment facilities, focused on substance abuse as well as mental health. And the insight that they had is these facilities have a core health record, EHR, and they in many cases have some CRM for prospecting new folks to come to the facility. After a patient leaves and becomes alumni, there's nothing. They just enter this void. And again, it's kind of, what does the person do? There's sometimes an alumni coordinator. They pull out their phone, they have a spreadsheet, and they just occasionally keep up with people. And what that misses, there's tons of data that can be captured, which helps insurance reimbursement, helps compliance, and also it helps identify if someone's not doing well and you want to try to get them back, for another stay. And so this company Embark realized that and has built software to facilitate that post-discharge process. So to facilitate the actual post-discharge workflow and this alumni engagement to keep people sort of in the family, keep them engaged and collect data that has a lot of big benefits for companies. And then another company we've closed this year, another vertical software company, you're probably getting the hint of stuff we like, is a New York City-based company called Toughleaf. It's compliance software in the construction space. We spent a lot of time looking in and around the construction space. We generally love these big, meaty, heavy industries that tech kind of hasn't paid as much attention to. The pithy comment is always sort of the unsexy, aviation, public airlines, behavioral health, construction sites, manufacturing, all those types of areas. Those just tend to be huge spaces with tons of opportunities and a lot of legacy software, which usually creates a big opportunity for new entrants. And what this company had the realization of is for public projects, whether that's funded by the federal government, state government, municipal, DOTs, there's almost always some requirement that a portion of the budget goes towards specific groups of subcontractors for general contractors. That could be, depends on the state, could be disadvantaged businesses, local businesses, minority or women-owned businesses, veteran-owned businesses. And it's really hard for the general contractor to solve that. Like there's a bunch of publicly available databases that are outdated. They spend a lot of their time cold calling these subcontractors and praying that they pick up the phone so that they can get them to do, take the job. And Tough Leaf handles all that for them. So it's basically, it lets them fulfill that compliance requirement, helps them win the public projects. And especially with a lot of the infrastructure spend now going on in the US, there's a lot of these opportunities. And then they help them ensure that they're staying in compliance because the penalties are really severe if you want a project and you're not spending the amount of money you need to. And we generally, you probably can tell from these three companies, we love software that touches compliance because it tends to be really sticky, right? It's hard to rip out software that helps you fulfill an obligation to a regulator. And so, this one very much does that for their customers and actually soon to be, for other players in the ecosystem too, just helping to maintain compliance.
Very good. Thank you so much for those overviews. I really appreciate that. And that certainly does give us an idea of the companies that you have interest in and have seen an opportunity for their products and services to basically make a difference and differentiate them from, like, as you said, from legacy software apps. So in that situation, let's move on just for a moment. I'm going to ask the audience, you probably saw a polling question if you were involved in a raise at this point in time, the size of that raise. If you haven't had an opportunity to answer that question, I'd appreciate it if you could go back and do that, because I want to talk about the raise process for just a second. And I want to ask David to really take us through his viewpoints on a raise in opportunity with a client that really meets all the filters and everything else of coming into and being and working with your company. David, tell us about how you interact with management during that process and what you think is important that they really understand about your role and specifically the question, do you take a board seat? Do you not? How do you advise and consult and move them forward?
Yeah, absolutely. So the first thing I'll say, and this is trite and overused, but it is a very long-term relationship you're forming, between a founder and their investor, especially an institutional investor. So it's really important to build the relationship. It's really important, I think, to meet in person. It's really important to meet several times to really dig in. A lot of that inevitably happens for an investor when we do diligence. I can't even count the number of calls we have typically before, or calls or meetings in person that we have before closing an investment, digging in on everything, right? Who are the founders? Who are the team? What's the product? Seeing a product demo, talking to customers, getting a sense for the space, going through the data, understanding the data, analyzing the data together. So it happens inevitably in the process, but I think it's really important on both sides. Obviously, I'm talking from the investor side, but from a founder side, really vetting, how do you feel about this person? Because this person is going to be really important in your life for the next, anywhere from 3 to 10 years, hopefully, so you go to an exit. And so, I think it's really important for both sides to vet and decide if it's the right type of person. In terms of Reformation, we are on the spectrum investors. We're very much on the high conviction end of the spectrum. So we only do 4 to 5 new investments per year. We pick our spots, spend a ton of time with our companies. We do typically take board seats or rights to board seats, depending on the circumstances of the company and how early it is. And we spend a lot of time with our companies. We meet bi-weekly with our companies, sort of standing office hours. We obviously meet quarterly for board meetings. I'm texting with my founders all the time. So, and different investors have different models. We're, sort of institutional high conviction. There's obviously investors who will write angel groups and others who will write smaller checks and to a much larger number of companies. Our first fund had 12 investments in it. Our second fund will have more than that, but not much more than that. So we really, invest in these relationships and try to be helpfully involved without being overbearing. I think that's also super important. We know what we're not good at.
I think also one of the things that I wanted to mention is that you are generally the lead, correct? Lead investor.
Correct. Yep. We, in almost all cases, lead.
Okay. That is a very, very important piece of information to understand about your company, and also just from the standpoint of answering the question, because and I want founders and people who are on this webinar today to take note. I'm going to ask the question, what are some of the key mistakes that you see founders making right now or over your career you've seen?
So I'd say a couple things, especially on the sort of, especially presuming that some people on this chat might be in the, thinking about a fundraise, pitching a fundraise, and that side of the process. I would say, one thing is do the research and know who you're talking to, right? And it's important, just like you A/B test with customers and have different, landing pages. It's kind of the same idea, I would say, for investors. Like if realistically you're going to be talking to a lot of investors, you're going to have a very wide top of funnel, and all those investors are going to be looking for different things. And a lot of this you can research by just, Googling and looking on their website, and maybe reading some of the stuff they wrote, things like that. So, I'd say it's never a great look when we're pretty clear about what we look for. And if you have a founder that, comes, especially a founder that's proactively sought to talk to us and pitches something that's, hey, we're raising for 12 months, we're going to burn it down. We're absolutely going to raise a Series B, and this is going to be everything or nothing type play. It's just they didn't do their research, and frankly, probably could have saved themselves time. And so I'd say, thinking through that, titrating your list based on that, and frankly, kind of like different landing pages, I'd always advocate you can have multiple versions of your pitch deck, right? It's not something that people talk about a lot, but don't have a pitch deck in a fundraising ask that isn't true. Like you want to truly believe that there are multiple paths your business can take, but it's not a bad thing to say, hey, there is a world in which I raise a $8 million round, and there's a world in which I raise a $3 million round, and they're just different formats. Like one is going to be more, I'm going to go really big or go home, and the other one's going to be more, I'm going to double for 4 or 5 years, and that's fine. And when you're talking to different investors, you can talk about the different strategies. And frankly, from those conversations, see which one feels more comfortable and feels like a
Just
better
from that
fit.
standpoint, though, too, David, can you give us some pitch deck do's and don'ts?
Yeah. So number one is keep in mind investors look at a lot of pitch decks. So the last thing you want to do is have something that is either too long, too wordy. Like you want the key points to jump out. So I always tell founders, number one, absolutely have less than 20 slides. Do not have more than 20 slides, ideally even less, 15, to the extent you can help it. The whole point of a pitch deck is to get a conversation and then to get a second conversation, to get a third conversation, right? So you're not trying to tell the whole story necessarily with your pitch deck. I think that's important to keep in mind. In terms of format, I mean, what I generally like to see is I always advocate have a first slide that's just the TLDR, right? So kind of what do you do? Where are you? The key, punchline, traction metrics. What are some key logos? What are you looking to raise? Like putting that up front on the slide for two reasons. One is it just, I think, helps center the conversation right from the start. And two is, again, as a founder, you don't want to waste time. You don't want to, if you're at 100K of ARR, you don't want to talk to an investor that's looking for $1 million of ARR. It's just not a great use of your time right now. It absolutely is to build a relationship, but at the moment that you're like looking for funding and it's like super actionable today, you should prioritize the ones that look for 100K of ARR.
Absolutely. Yeah, the idea of making sure you've got a fit from the moment, from the get-go is a very important situation. Otherwise, the rest of it's either a very potentially opportunistic situation for you, or it's just going to be a waste of time. Okay.
Yeah, I think that's right. I mean, I do want to reinforce there is absolutely value, and we love building relationships with companies. So we talk to companies all the time that are before our range, and that's great. And frankly, I think it's better to build that relationship, assuming things are tracking the right direction. You're not, multiple years off. But for a founder, like if you're really trying to prioritize your time, you really need to raise, right? Like, think about that versus doing relationship building conversations between raises, for example.
Yeah, absolutely. David, let me ask you a professional question with regard to what you do. What really gets you excited about a new deal?
Yeah, I think people go into investing because they're curious, and I'm certainly a curious person. So I love learning about new spaces. I mean, especially with vertical SaaS, right? Obviously, as an investor, you're 10,000 feet wide and 2 inches deep or whatever the saying is. But for those spaces that you invest in, you go a lot deeper, and you understand a lot more. And then actually, frankly, when you go into a space, you end up finding a bunch of other pain points, and that ends up, building out little theses in the spaces that you are able to go deeper and find more portfolio companies. And I love that, and my partners love that. We love finding interesting quirks in the market with big opportunities, and then finding founders who are passionate about it. There's nothing more fun than sort of finding a company that's working where everyone's aligned and sort of looks at the world in terms of company building in a similar way, and then getting to partner together. That's why we do it.
Great. Thank you so much for this opportunity, David. We could probably spend a couple of hours with you and hear just a lot of very valuable information. I'm going to wind this up just with that. Just one last question for you before we take Q&A. And I would just really appreciate just that particular answer. What is the typical path that successful companies follow post-investment for you?
Yeah, so I'd say this is also sort of like what do our best founders do?
Yes, it really is that kind of a question. It reflects on the management that you place your trust in, the money you've invested. What is really a success story for you?
Yeah, so I'd say it's founders that are confident and willful, but open to feedback and receptive to feedback, and frankly, egoless, I think is incredibly important. So, our companies that do best upon raising just immediately start sprinting like crazy at hiring. What are the everything that we just talked about, like why are you raising? Just start putting that into action. Whether that's doing it directly, whether that's working with recruiters or partners or what have you. Just starting to not over, you want to be thoughtful, but not overthink, right? And in startups, it's often, good is the opposite of perfect. Like I think that is true, especially in the early days of a startup. And it's okay to do things that aren't super scalable in the short term to figure out what works and then to figure out how to scale it on the back end. So I think that's true in hiring. I think that's true to some extent in product, although obviously with some product things you want to be very careful, especially if it's anything critical. Certainly on marketing our best founders A/B test like crazy. So, want to see folks, it's throwing spaghetti at the wall and seeing what sticks. So you just don't know what's going to work, practically speaking. You know what has worked and you try to lean into that, but try three other things. And again, it's beauty of software is it's really easy to spin up a landing page. It's really easy to do a new campaign. It's really easy to tell your AEs, hey, this week we're going to go after credit unions. And so just test a lot of stuff, see what works, and then end it quickly. Pull the plug if things aren't working. I think that's important. I think also our best founders, we see folks be quantitatively ruthless, right? Especially on the sales front. I mean, you have the benefit on sales, less so on product, that you can very clearly quantify if something's working or not working. And if it's not working, it's rarely not going to work and then going to start working. So I think, changing things up
Recognize
is
the
necessary. Yeah. And that's the nature of building a startup. And again, and I mentioned this word, and I think it's really important, being egoless. Like our best founders, they know what they're good at, and they're very well aware that what they're not good at. And I think you sometimes see CEOs who say, I'm the CEO, therefore I must do everything. I must know everything. And, everyone will have to be, will have to be under me. And that's not how good companies get built. I think the best CEOs say, I'm not good at marketing. I'm going to go hire someone who knows how to do this, who did this before and can now be my CMO. Hey, my operational structure, I don't know how to build my org chart when I'm scaling from 6 people to 36 people. I better go find a COO who's done this before, right? And constantly leveling up your team. Frankly, having people who are better than you and that can teach you and that can take over that level of the org. And ideally, people who have done it before and seen the journey from 1 to 10 or 1 to 20 million of ARR. Those are our best companies, and where founders recognize that. And obviously, to be a founder, you have to be exceptional at something and leaning into that, but letting others do the things that you're probably, maybe not as exceptional at.
I understand. Let's go ahead and move into the Q&A session, David. We've got a couple of questions here, a few in the chat box. Marta asks, she said, I'm gently developing a miscarriage support program for women after a pregnancy loss. Given the current trends in healthcare investment, what would you say is the most compelling aspects of early stage healthcare startups that attract your attention?
Yeah. So, and healthcare is a space we've certainly have been and have spent quite a bit of time. Healthcare, it's obviously a very, very broad space, right? With a lot of things that fall into it. I do think maternal care is a really interesting space. I think it's picking, there are certain areas that are highly, highly, highly competed and very capital intensive. So pick like the core systems of record in a hospital or a medical practice, like an EHR. Those are really hard to build and really hard to get people to switch into. We generally like things that are think of them as almost like feature sets or modules or needed products that sit on top of those core platforms. Because again, you can be a lot leaner and a lot more efficient building on top, and then eventually eating more of the stack. I think maternal care is absolutely a place that's the case. Obviously, there are some large players in and around well, primary care plus maternal care and OBs and other things in and around that world. But figuring out what are the key areas that have been overlooked. Probably the big platforms have some support for it, but don't do a great job of it. And I think, diving deep into those types of things is important. And then also thinking about the customer. Are you going to sell to patients? Or are you going to sell to practitioners? Are you going to sell to hospitals? Are you going to sell to private practice? All super different sales motions, and some much harder, some much easier, some more capital efficient, some less capital efficient. So I think, thinking a lot about that stuff
Thank
is
you.
important.
Yeah, very good comments. Next question comes from Hardy. Does Reformation Partners invest in companies domiciled outside the U.S.?
So we look predominantly in the U.S. and we'll also look in Canada. We generally stay in those two markets.
Okay, very good. William asks how do you think about what do you think about a pre-series A and post-series A vertical SaaS companies who should be the target mix between channel and direct customer revenue mix? I'm not sure I got all of the thought process in there, but hopefully you understand the question.
Yeah, no, it's a good question. So the more direct, the better, because you control it. It depends what channel means. If channel is it's an introduction source, it's on your paper, that's totally fine. And you give them a cut, that's a very normal motion. You also see companies where channel means it's their paper and it's sort of, you have a single choke point and 50, 60% of the business goes through that channel and it can grow your revenue, but obviously you have a lot of platform risk on that channel partner. So I think it's really specific to how the channel works, but having partners is great. Having folks who refer into you is great. Having revenue share to them, and frankly, we view that as it's a salesperson, and you're paying them commission rather than paying your salesperson necessarily the full commission. So I think it could be healthy, but I think it's just very important that you control the relationship. You control in many cases the support, and it's your paper, so it's under your control.
Very good. Last question from Eric. Wanted to know if you have any high-level thoughts on things that you like to track from your VC portfolio companies.
Yeah, another good question. So, and a lot of this stuff are metrics that I think come to bear, especially as you get to that, a little more evolved, so 500K to $1 million of ARR. So certainly, it's annual recurring revenue, MRR is very important. Customer concentration, so is an interesting metric to track. Year-over-year growth, which is a derivative, but obviously helps to give a story of momentum. How much of the ARR being added is new versus upsell, downsell, churn, right? And tracking those separately, because you can sometimes get in a situation where the company's looking great, then you pull back the hood and it turns out it's all upsell. It hasn't been new business. And it's like, okay, our CSM team's great, but our AE team is completely fallen off the wagon. So getting very upfront about that, I think is useful. Retention is incredibly important. We generally look at three things. So it's logo retention, it's gross dollar retention, and it's net dollar retention. So basically, do you account for upsell? Do you not account for upsell? Do you look at the logo or do you revenue weight the logo? Looking at all those things, I think both on a monthly basis, but more importantly on an annualized cohort basis is really, really important. I actually often like with my companies to look granularly on look pipeline, basically looking monthly pipeline, what deals get us to our plan, really breaking it down to those atomic units. Also, obviously, at the salespeople and how they're performing to their quota. But we like to look at that because again, a lot of these things are what help you diagnose an issue before it's an issue, right? And I think the most useful dashboard metrics are those that they're backward looking, but they're sort of forward predictive, which we've found a lot of these can be.
Very good. Thank you so much. David, it's been a pleasure visiting with you today. I'm sure all of our participants would agree that we've been richly rewarded for our attendance today. And thank you so much. Thank you, Esteban. And obviously, I saw Rich Robert come on a little bit late on in the program. Rich, would you like to come on and talk to us a little bit about JustWorks, please, before we close?
Yeah, absolutely. Absolutely. I appreciate it. I'll just speak on the partnership itself that we now have that's blossoming with Escalon. Before I go into that, JustWorks, we are a PEO, professional employment organization platform. We have a suite of products that really help the new founder either seed and post. And we have an international product that we're really proud of and focused on that we're looking to really kind of bolster this kind of year ahead. And for us, it's important to make an impact, meet the founders where they are, really kind of understand what their immediate needs are when they're looking to scale and see how we can really take care of the behind the scenes important factors of building a business, and we want to make sure we can take care of the things that you should not be worried about, like your payroll, your benefits, all that stuff. Let us handle that, so you could really focus on, growing your business, working with your revenue team, your marketing team, and doing things of that nature. So I appreciate having me on briefly. I apologize again, and definitely nice to meet you both, David and Ted.
Thank you very much, Rich. Appreciate it. To all of our participants today, David, thank you again. Very, very great pleasure in having you on the program today, and appreciate your counsel and the words that you shared with us and the information that we gathered. Esteban, thank you very much. And thank you to Paglaw for joining us as a sponsor. Same to you, Rich. Thank you very much for JustWorks. And we'll go ahead and sign off at this time. Thank you very much to our audience for your participation today, and have a good day. Thank you very much.
Thanks, Ted.
Bye-bye.
Thank you.